How the Fed is fueling the next housing crash. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is September the 11th. I'm Randy Patrick, your host, putting the realism back in real estate. Today we will talk about how the Fed is, I guess you could say, stoking, fueling the fires for the next housing crash. I mean, we can see it out there right now. Low interest rates, people competing for properties, values plateauing or still rising a little bit here. What's going to happen? As I mentioned before, it's weird because we basically have a boom market going on and we have a bust housing market coming up very shortly. So let's get into it right now. But first of all, if you're not already a subscriber to my channel, if you could please smash that subscriber button, I'd really appreciate it. Thank you. All right, let's get into it right now. I think today will be a little bit of a longer video just because we got lots to talk about. All right, lots going on. Hope everyone had a great Labor Day weekend, had some relaxation. I think pretty much school has now kicked in for every location across the country. Down here in Florida, we start in mid-August, so they've already been at school. And I know other parts of the country, especially the north, it starts on Labor Day. So anyway, how the Fed is fueling the next housing crash. Why do I say that? Well, because it's exactly what's going on right now. Let's take a look. So, of course, what do we have here? The Fed now owns nearly 1/3 of all U.S. mortgages. Can you believe that? So, yes, if you take a look at the total balance sheet, where we are at now, we're at 1.977, I guess you say trillion. That's up 1 trillion since March. So the Fed basically is buying a ton of mortgage-backed securities. Simple as that. So they're underwriting a lot of the loans that are being given out lately over the past little while and pushing that balance sheet as high as possible. Why is this a concern? Well, I think anytime the government has that much interest in something, I think it should be a concern. But again, if you read this, and this came from the website, it's Mish Talk. I think his name is Mike Shedlock, and it's his. He has a number of economic discussions on his website, so this is public information that's out there. But I do personally appreciate him putting the stuff out there and the spin he puts on things. It's pretty good. So essentially, the Fed snapped up $1 trillion of mortgage bonds since March. It bought around $300 billion of the bonds in each of March and April, and since then has been buying $100 billion a month. The Fed now owns almost 1/3 of bonds backed by home loans in the U.S. That's an astounding amount of real estate there. Buying the securities has pushed mortgage rates lower, with the average 30-year rate falling at 2.91 as of the last week from 3.3 early in February. Mortgage Stanley analysts point out in late March that the buying was running at 8 times the pace seen in prior episodes of Fed purchasing under programs known as quantitative easing. So essentially what they're doing is, that's why I said they're stoking the fires. I mean, quantitative easing was designed in conjunction with how the last housing crisis foreclosed inventory was kept away from the average buyer, kept off market and controlled. Along with quantitative easing, it was basically, that's how we recovered from the last housing crisis. So to see that they're running at 8 times that pace is quite remarkable. Just before this latest round, principal payments from his mortgage bond holdings had whittled down to 21%. Now it's increased to 30%, and if they maintain the pace of its current buying, it will own 34% of the mortgage universe by year's end. So that's a significant amount of mortgages these guys are backing. So that's a concern, I think. Let's go to the next slide here. That's the balance sheet. So you can see their balance sheet has taken off really since the past couple of years. It's done a big spike. And if you go to the last, sort of that first gray bar in the middle, that's really where the last housing crisis kind of plays in. So you can see where they've gone with respect to quantitative easing and purchasing mortgage-backed securities. All right, next slide here. Again, Feds. This is from Bloomberg. Fed's mortgage buying spree at 1 trillion with no end in sight. So basically, they're just they're underwriting these mortgages, right? We all know how much of the FHA stuff they're doing, right? VA, Ginnie Mae stuff, whatever. And we realize that a lot of FHA mortgages have what? Low, what's their commonality, or what's their sort of attraction? Low down payment, reasonable interest rates, trying to reduction in closing costs, high debt to income ratio. So really, it's the subprime of today's mortgage market. That's how many analysts take a look at FHA and those type of loans. So ultimately now we can see that a record number of borrowers can now save on mortgage refinances as rates set another historic low. What's interesting about this is the fact that every time there's a rate decrease, you have these data companies doing it, analytics, whatever. In this case, I believe it was Black Knight Financial. Basically, they come out and do some calculations saying, hey, based on the current housing situation, the current number of loans out there, and where there is equity, they do some quick mathematics and they go, well, gee, now we've got 19 million people who could benefit from a refinance now, and that's rate and term to just save your monthly payments. Or what they're saying is that because of where equity's at today in home values at 19.3 million people, they fall under their 80% loan to value number calculation for a refinance. So they could jump in, refinance rate and term, or which a lot of people do is they pull money out. All right, they actually pull money out of their house, their equity, to use for whatever they want, and it doesn't necessarily go back into home improvements. So please keep that in mind. But again, we just keep seeing every week now it's like a lower and lower interest rate, and more people are being, I guess you could say, enticed to do this. Now listen, if you're stable environment, stable job, great income, whatever, you can save money, by all means. I'm not knocking this whatsoever. But the key though is on the home purchases. All right, is that if people are stretching because of lower interest rates, that could put them into some precarious situations in the future. And here we go. Here is that, again, this comes from Mishtalk. We're at the largest mortgage origination volume on record. So you take a look at that. Again, the left-hand side of the graph, and they typically always compare the last housing crisis, so that the second, we'll say, bar part of the bar chart in from the left-hand side of the graph looks to be around third quarter 2005. Obviously, with the blue component being purchase originations and the green component being the refi originations. Well, let's fast forward to the very right-hand side of the chart. What do we see here is we see that the overall mortgage origination has surpassed where we were back at the peak in 2005. And when you take a look at the green bar, so you can see that mortgage refinancing has spiked big time, and people can do that. So again, whether it's cash out or rate and term, clearly people are being enticed, solicited, whatever, to come and spend money or pull money out and do whatever you want with your property. Okay, so a record low interest rates, this is his comments, led to a surge in mortgage refinance originations. According to Black Knight's Mortgage Monitor, a surge in refinance lending driven by record low rates leads to the largest volume on record of originations. All right, I want to look at some key points here. Basically, we've got Q2 of this year, largest quarterly origination volume on record, nearly 1.1 trillion in first lien mortgages. More than 2.3 million refinance loans were originated in that quarter, highest volume in 17 years. And when we start looking at what's going on here, that's a concern. And why is it a concern? Because if we look at refinance and we look at people pulling money out, that's a term called equity stripping. So when you equity strip at the time of peak, because it's very attractive, that can cause issues, if volumes or values change in housing prices. All right. So again, if we go back to the last housing crisis, which I like to compare, just because we've got the ability to do so, we have the information, we saw what happened. Going back in time, I always state this, that subprime was the kickoff, but the real sort of mortgage issue that hurt and fueled the housing crisis then was cash out refis. All right. Again, refinance lending was up more than 60% from quarter to quarter, more than 200% for the same time last year. Wow, that's a lot. I guess you could say rate lock data, a leading indicator of lending activity, supports the growing consensus that the spring home buying season was shifted forward into the summer because of the COVID pandemic, which we know. Overall purchase locks scheduled to close in Q3 are now 23% above the seasonal expectation. All right. Locks on refinance loans that are expected to close in the third quarter are up 20% from Q2. All right. Despite nearly a 17-year high for refinance originations, just 22% of rate term finances and 13% of cash out refinance borrowers were retained in servicers' portfolios. So what that tells me is that most of the loans that were used for purchases and refis rate and term refis and 30% of cash out refis were retained in the servicers' portfolios. That means the other part, the stuff that wasn't retained, was most likely sold to the GSEs, government-backed, FHA, whatever. Okay, so delinquencies were down, but serious delinquencies were up. And obviously, his comment there, 0.78, are interesting. So yeah, so when we have what should be high equity or peak equity and coupled with low record interest rates, that's the recipe to get money out of your property, which again could be a potential recipe for disaster in the future. We don't know. All right. And just again, I always like charts. These loans that were all securitized or dumped on the GSEs, putting taxpayers at risk for another bailout. You can see that, where I guess you see that this is the mortgage delinquencies by severity, and the green and blue lines are decreases of 30-day and 60 days, whereas the gold yellow line increase. So what typically happens is, obviously, as 30-day and 60-day loans that are delinquent, gain and mature in time, the 30 days drop off, which also means that we had a big surge of them earlier in the spring, and now we see that the 30 and 60 days are kind of plateauing a bit, are coming down in volume, but the 90 days, which is where all these original loans that were 30s and 60s, are now growing. So again, the more serious delinquent you are, the less chance of actually, I guess you could say, curing that and going current your mortgage. And basically, both 60 and 90-day delinquencies remain elevated, with 250K more 60-day delinquencies and 1.84 million 90-day delinquencies than there were in February of 2020. So you can just see in the short time frame since the pandemic hit, bang, our delinquencies skyrocketed, which is out of control here. Okay, active forbearance plans. It seems like everything is kind of, after we had the initial surge, it's kind of plateauing. Most of the weeks we see a decline in forbearance applications or forbearance starts. All right, but forbearance starts have shown little impact from the reduction in expanded unemployment benefits thus far. Perhaps not, but what about serious delinquencies? So you see again, we may see ebbing and flowing on the short-term delinquencies, but a lot's going to go longer term and get into serious world. All right, Mortgage Monitor again just shows that you can see that the first lien mortgages spiking with their on the first chart, the left, spiking with their delinquencies, and we can then see the correlation, with it going to 90 days. That's pretty obvious there. This is interesting enough too, and I'm going to look at my charts here so I can read this appropriately. So this is kind of a heat map. So we can see that the teal, the bluey, the teal color is basically where we have increases in delinquencies, and then the green areas are where we have decreases in serious delinquencies. So very interesting. So you can see how that spreads out across the country. Let me go and enlarge some of this here. So great. So the 10 markets with the largest delinquency rate increases: Miami, this is a month-to-month increase; Las Vegas, Orlando, New York, New Jersey, New Orleans, Louisiana, Houston, Texas, Atlanta, Georgia, Tampa, Florida, Riverside, California, and Dallas, Texas. Now, so you can see how that's, and this is month to month. So going from, this is probably July data or even August data. So it's either June to July or July to August that they're looking at here. But when you take a look at that top 10, and why I say that is, I remember a few videos ago, I talked about FHA loan delinquencies and where they were spiking. And there was a top 10 chart that showed 10 metros most threatened by high number of FHA delinquencies. When I look at their top 10 and compare these top 10s, well, Atlanta's up there. Yep, it's on this one here too. Houston's there. It's on this one too. Riverside's there. It's on this one too. Orlando is here. Yep. Tampa is here. Yep. Fort Worth, Arlington, Grapevine, that's the other side of Dallas. Philadelphia's here but not up there. Baltimore's here but not up there. So really, you're pretty much, having most of the top 10. Vegas isn't on this list, but it's like the next couple down. So really, it's, how can I put it? Like, these cities should not surprise anybody of what's going on here. All right, simple as that. The fact of the matter is that highest delinquency rates will eventually lead to more distressed sales, more pre-foreclosures, more foreclosure auction sales, more third-party bidders at the auction buying, and eventually more bank-owned or called real estate-owned REO homes coming back out in the marketplace after that cycle has gone through, from start to finish on the property. So again, these are the places that were hit hard last housing crisis. We've only got one, I guess you could say, California location there because of some of the California pricing increases, but I expect that we'll see more as we expand this chart. We're probably going to see some differences as time goes on. Now, of course, with the largest delinquency rates, we have a chart with the, guess what? We're going to have the other side of the coin here. So let me just move the slide over here. 10 markets with the smallest delinquency rate increases. So and really, if you think about it, you're going from the bottom upwards to the top. But again, we got San Fran, Pittsburgh, Indianapolis, Louisville, Kentucky, Birmingham, Alabama, Richmond, Virginia, Cincinnati, Ohio, Milwaukee, Wisconsin, St. Louis, Missouri, and San Jose, California. So, some of the locations like San Fran had some problems in the last housing crisis. Out of this, I don't really, everything is, other locations got hurt, but they were not. I don't think they saw the big swings that some of the, the previous slides locations did. So, a lot of these Pennsylvania, Indiana, Kentucky, Virginia, Ohio, Wisconsin, Missouri. So I mean, we're not seeing, I guess you could say coastal regions or major, port cities or things like that. We're seeing, I think, more stabilized economies, more stable population base, things like that. So for whatever reason, there's I guess you say less delinquencies going on in, these locations. Now clearly, they're still happening, right? But not as much. Like we're talking, these are the bottom 10 out of the 50 as opposed to the top 10. So I'm sure there's stuff in the middle that we can talk about. They didn't produce that for us to look at. All right, take a look at this year. Again, we're just showing the mortgage monitor with respect to the forbearance and how it's plateaued. You can see how it grew kind of exponentially, that kind of plateaued. Every week when I look at the information, what we're seeing is, okay, this week was kind of flat. This week was a small increase. Oh, this week we had a small decrease from previous week on forbearance starts. So there always is people going into the forbearance arena asking for forbearance support to get it going. But we're also going to see, so I guess you could say the volume is sort of plateauing. These charts show active, all right? So how many are in forbearance at any given time? Let's go to the next slide here. Now you can take a look at, how you can see that extensions and removals. So forbearance, as we all know, is it's not a forgiveness. It's a promise to pay. You're just taking a little time off from your payment plan, which is very nice. So you can see when they all spiked up, when the first, I guess you could say, pandemic hit, and with a little mini spike, sort of, a couple months afterwards. What's going to happen? So these forbearance plans, typically they're 6 months or they're 12 months. Some lenders can break them up into 3-month kind of, segments. So you're done your 3 months. Do you want to keep going or not? That does happen. So obviously the chart on the right, you're going to see those are the new forbearances that were coming through, the lighter color, like the light blue, and then you see the ones that are sort of being reset. So the active forbearances are going down, but what's happening also is the active that's expired in their current forbearance plan is now jumping into a new forbearance plan. So we're having transitioning because we're seeing some of these increments now finish out. This month is September. So if you think about it, if you took a forbearance in April, May, June, July, August, September is 6. I'm counting my fingers here, guys. I don't do math in public, so I'm using my fingers. So 6 months. So at the end of September, we're going to see a lot of people who are going to come out of forbearance plans, and then what are they going to do? Do they have to re-up for forbearance? Are they going to go delinquent? Are they going to refi? Are they going to sell? Are they going to be back to normal with work, and therefore they can start paying their mortgage regularly again? So who knows? But at the end of this month, that's going to be a lot of volume will be transitioning with respect to the forbearance and the lenders. So keep that in mind. And just wanting to point this out here, I'm going to go to some of my charts because it's important that I'm on this here. What this sort of shows us is that did I print these ones out? Look at that. I did not. Oh man. Okay, I'm going to have to eyeball here, but these two charts are kind of important because you've got the one on the left, which is your forbearance, okay, which is total forbearance versus active forbearance. So if you actually take a look at that top teal line here, we have about 6 million people that have, since the inception of the forbearance plans, since they've been tracking this with the pandemic, have been in the forbearance plan, yet today, or the most recent report here, showing about 4 million. So we see a drop of about 2 million people who have sort of come out of forbearance. Now, it doesn't mean that everything is wonderful with them, all right? Realize that, there's components to this. So going to the pie chart on the left, so the pie chart on the left, the biggest chunk is the current, forbearance people who are currently in the forbearance programs. The blue part to the bottom, I believe, is people that re-entered forbearance. All right, so their plan expired, but they had to go back in. So if you think about that, still between the two bluey colors, still that's the majority of people. The green is actually part of the pie chart, to the top right there. The green is people who are out of forbearance and back to normal. Now, so what does this mean? It means the lender, they're either paying their mortgage or their lender has worked out some plan. So you see what this is somewhat misleading, because doesn't, when people are out of forbearance, it doesn't mean that they're back to paying their mortgage and everything's great financially. So what happens, either they are paying their mortgage, so they're current or allowed under whatever plan that the lender and them have worked out to continue paying their mortgage without being in forbearance, without having a foreclosure case moving forward. So it could be a loan mod, it could be a workout plan, it could be, hey, we're going to spread these payments out over a period of time. Hey, we were lucky, we're putting this at the end of the loan. We don't know what those plans are, but a million and almost like 1.5 million people basically have fallen out of that, which is great. We have the sort of gold section, which basically is they're out of the forbearance plan, but they're delinquent. So in other words, for whatever reason, they didn't re-up it or couldn't re-up it. We don't know what that means. It's not as explicit there, but they're delinquent. So in other words, these people will be on the faster track to foreclosure now because they're not in a forbearance plan with protection, and or they couldn't remain in it, or they can't qualify for something, or they just haven't bothered. They've given up, whatever. So there's 250,000 people there, and then the bottom, so the gray piece there is they sold their property, so they paid off. So clearly, with what's going on in the marketplace, if you were a few months behind, you could possibly tap into your equity, and that's great if you can live for free for a little bit, get yourself a reprieve, and sell your home. And now you've sort of paid off your mortgage, you paid off those back a few months, and now you've got your equity. You're moving forward to do something else. Good for you. So that's a component as well too. But I'd like to highlight this kind of back to the last housing crisis. So one of the main issues that we encountered, or many homeowners encountered in the last housing crisis, was the fact that when they were asking their lender for help and support, that wasn't given. And it wasn't necessarily on purpose, we're not helping you. I think a lot of it was just they don't have the capacity, they don't have the ability to for staffing, they didn't have the programs, they weren't able to explain the programs. I have lots of horror stories where people basically sent in, again, faxed in all these documents and they couldn't fax, or the faxes got lost, they did it 10 times. Like, it just was the biggest, I guess you say, cluster, and they lost their homes. So, but some people did receive loan modifications, and for those people, some were successful and just maintaining and coming out of that unscathed, and everything's good. But a lot of loan modifications or workout plans after a certain period of time re-default, which means that they had some luck or they had some change in their financial world initially so they could try to make things happen. In the end, they couldn't. They ended up not paying their mortgage again and falling back into the delinquency status, and then moving forward through the foreclosure process. So again, we don't know or talk about that, but out of that green pie piece up top, there's going to be a portion of those people that will happen to. All right, simple as that. Okay, next slide here, guys. So, I expanded this. Okay, number of forbearance plans over time, again, so it's a little bit larger. We can see that we're up to almost 6 million, or just below 4 million now, so that accounts for about 2 million in difference. And if this is bigger, yep, there it is. Okay, so we can see that better now. So yeah, left still in forbearance, term extended, 2.8 million, that's 48%. So I had that reversed. Okay, so people that had their term extended, 48% of the people in forbearance. still in forbearance, 18%, 1.07 million. So what that means is that when they entered, they're still in their initial term. So their term hasn't expired. So they're still in their first forbearance agreed term. Up to the top, 26% are removed, expired, or performing. So again, the thought is we're paying our mortgage. We've got a loan model workout plan, something that has been agreed to by both parties. The gold pieces I mentioned, removed, expired, delinquent. So they are not in a forbearance protection plan right now, and will be moving through or to the foreclosure process. That's another 250,000 properties there. And then 274,000, that means they paid off their mortgage, 4% paid off their mortgage in total. Obviously with some of the appreciation, if they only had a few months, they were able to get out of that. So there, if you add all those, 1.5 million, 2.8, whenever you add all those up, you get to almost 6 million, which is, which correlates to the previous chart with the lines and the 6 million almost to 4 million almost type of thing. So it does seem to make sense what they're saying here, even though I do believe that Black Knight Financial, I think, is a more conservative, I guess you could say, data services producer, especially in their reports like this. So I actually believe there's more delinquencies out there that aren't being captured or reported in either the forbearance or the overall stats. So again, just be aware of that. When we take a look at, I just want to point out here that all these delinquencies just didn't happen from the pandemic. There were delinquencies that were there before the pandemic, and what a lot of the lenders did, and the government as well too, they basically said, hey, if you were delinquent beforehand, we're going to allow this pandemic, this COVID-19 forbearance plan to help you as well too. So they actually kind of took in a number of mortgages that were previously delinquent and kind of put them under the forbearance umbrella, which obviously caused the forbearance to numbers to surge, etc. But the point is, it wasn't like we only had 100,000 people across the country not paying the mortgage. We had a million plus here, so nothing to sneeze at. All right. Going to the forbearance status of the past due mortgages. This is a breakdown of, I guess you could say, who is owning the mortgages. So you can see how the distribution is there. Obviously, you've got Fannie and Freddie. You've got FHA mortgages, stuff like that. So it just shows how they're distributed. So clearly, there's certain segments of the industry that are purchase these mortgages or back these mortgages that are certainly more exposed than others, which we really have to keep an eye on because, again, I just think sometimes things can get out of control, and it's difficult to, when they're too far down the path, they're very difficult to kind of come back in the situation. All right, next slide here, guys. Firstly, in origination activity, just to review this, clearly the second quarter of this year was a massive origination activity. First liens, either purchase mortgages or refinances, but clearly the far right line, the blue is the purchases, the greens the refis. You can see the greens the green refi pretty much would be a large. If you just put that on its own, that would beat purchase mortgages every year for the past 15 years. There you go. So that's what's happening here. Now, what this also tells me too is that for me, every refinance is one less property sold. So people are looking at their opportunities, but they've chosen instead of selling and taking their money out with the sale to go someplace else. They're saying, I'm going to remain in my property, but I'm still going to take the cash out. You see, so that's kind of how the shifting of mentality is. I think probably with the pandemic and some of the relocation phenomena across the country, and working from home and schooling from home and things like that. So everything is changing right now in the real estate world. Again, just some basic stuff here. Firstly, again, refinance activity versus equity withdrawn versus cash out refinance. So you can see that we're still not up to the equity stripping that was done on the chart to the right. So of course that's the blue. The left part of the chart is the earlier days of the housing crisis, the last one. People were stripping out big time. You can see this not happening as much, but it is increasing from what it was traditionally over the past few years. All right, Mortgage Monitor here. This basically is just the data summary, and I've got the actual image here we can look at. It's a little bit bigger here. Let's take a look at it. Delinquencies were 6.9, top chart there, that top box. July 20, 6.91% delinquencies. Monthly change, it actually shrunk a little bit for the monthly change, but the year-to-date change, 114%. Yearly change, almost 100%. The foreclosures, are actually losing ground, and why is that? Well, because of the eviction and foreclosure sale moratorium. So what's going on now is those foreclosures are not being sold at auctions, or very few are, typically because there's a moratorium by the government, and some of the lenders have said, okay, we'll jump on the same bandwagon too. So people who should be foreclosed on are still in their homes, which is not adding to transitionary inventory in the marketplace here. And a lot of the foreclosure starts are down. Reason being, it's just because, again, if you start a foreclosure and you can't foreclose yet, what's the point? Number one. And number two, a lot of the court systems aren't at full capacity, or the clerks or whatever, they're not there. They're on skeleton crews, or they've got furloughed workforce, etc. So stuff's just not moving through the system very fast here. So that's kind of the scene here. But seriously, delinquency is growing up. So that's it was 4.57% of all loans were seriously delinquent in July, up 17% from the previous month, up 264% from last year. So that just goes to show you where things are going. And again, and even though we did see a few foreclosure starts, they were up a little bit from I guess you could say, I said from July to June. Some of the states that have specific moratoriums have language that allowed some things to open up a little bit, and also when eviction moratoriums are being reset. What I've noticed, and especially in Florida and some other states, is that each time they amend the, I guess you could say, statute, whatever, they're adding some specific language or changing some language to sort of slowly open things up kind of quietly. So optically it looks good, but if you start looking at some of the language on some of the moratoriums, it's starting to kind of open up to say, hey, if you can pay and you're not paying, that's going to be problematic, and we will allow your landlord to pursue an eviction. That's where things are going now, because face it, landlords are taking a beating in this marketplace here. All right, mortgage monitor loan counts, and I'm looking at loan counts here. So if you go to the bottom, that's the most recent, July. Total active count is 53,396 loans are active, according to Blacklight Financial across the country. If I go to the over a couple columns to the 90 plus days delinquent, I've got 2.25 million. All right, and which brings me to about 3.8 million who are total non-current. And again, this is where I do see some number discrepancies, because I've seen some of the fine print, some of these charts. They were talking about 1 million loans that are delinquent that they're not capturing in their information here. So that's why we're probably got 10 to 20% swing in some data. Probably it's conservatively, there's two things. I think these guys are conservative with how they report their data, and there's probably some lagging going on as well too, just because of the way data is collected and people aren't around, and things are changing during the COVID pandemic. So as I mentioned, I'm always underplaying the numbers I see that are produced by Black Knight Financial. But again, we're talking, at least to them, close to 4 million delinquent mortgages, 2.25 meaning seriously delinquent, which in my mind, to me, I interpret as these are potential foreclosures, because the more delinquent you are, the harder it is to come back current on your mortgage. All right, and going to one of the last slides here, we're looking at the state-by-state rankings of non-current loan population, and it almost doesn't really change state after state. So, the left column from top to bottom, there's left, central, and right. The left is where it starts. So the state of Mississippi has I guess they're ranking it by non-current loan populations, which is the fourth column there. So once you look at the state, you go to Del FC, like delinquents, foreclosures, and NC, non-current. So looks like Mississippi still leads with the non-currents at 11.8%. Louisiana next to 10.8%. We may find those will increase with some of the storms that came through there a couple weeks ago. A lot of low-lying area, a lot of rain. They got the storm surge. They had all that wind. That one hurricane, I think it was Marco hit there, or was Laura, I forget which one. But either way, expect to see in those locations certainly an increase in delinquencies. Hopefully, and again, the lenders make it easy to pop into a forbearance or protection plan with respect to the issues on natural disasters. So whether you can come out of them unscathed is the question. New York's up there, 9.7%. We got Hawaii 9.6, New Jersey 9.3, Florida, of course, at 9.3, Nevada 9.2, Connecticut 9.2, Georgia 9.1, Arkansas 9.1, Texas 9.0, and Maryland 9.0. Let me find California here. California's at 5.6%. When we start taking a look at, that's the non-current, but start taking a look at the year-over-year percent change column. Well, the right-hand column. I'm at the left-hand column, but left-hand segment of the three right-hand column. Okay, year-over-year change in non-currents. You've got Nevada with over 200%. You've got Arkansas 177%. You've got Hawaii 153. New Jersey 112. You've got Florida 129. We go over to the middle, Illinois at 86.6, and the rest is reasonable. Virginia 84, and you go to the right, D.C. District of Columbia 123%, California 165%, Minnesota over 100%, North Dakota over 100%, Colorado 161%, Oregon 142%, Washington, state of Washington 121%. So we can see that some of these lower delinquencies overall by states, when they do rise, it's significant compared to the previous month or compared to year over year. So this is what's going on. So I don't know whether low interest rates and quantitative easing are able to help the housing market, especially in locations that have 9 or double-digit non-current loans. You see, so that's, to me, it's like, hey, that's great that we see this potential here and we've got this set up to help, but can we really help? Does quantitative easing, does low interest rates actually help us or hurt us in this situation? So again, that's the larger version of what I had up there. You could just type in, go to Black Knight Financial. This is their mortgage monitor. You can download this. It's like a 20-some-odd page PDF. Take a look at everything. There's more stuff in here that I haven't added in just because I didn't think it was all relevant. More, how they break up their loans and vintages and things like that. All right. One more thing to talk about here. Again, this is from Mishtalk, and why this is interesting is that this article was talking about affordable housing schemes and how they don't work. And he just happened to talk about a housing scheme, affordable scheme, I guess, put on by the United Kingdom, the government over across the pond there in the UK. Now, it doesn't really relate to us, and that's how I'm not even going to talk about that part of it. That's what the first part of this slide talks about. But, you could see that if you go to the next slide, it talks about the U.S. comparison. This is where it gets interesting. So, this group in the UK or this whatever government entity is trying to promote affordable housing. And, for me, when I think of affordable housing, I just think of government red tape, hoops to jump through, programs that are confusing. You got to learn the stuff. You got to go to your local housing authority. Like, I don't really know what's available. Maybe that's not a good thing for me as a real estate professional. But in today's marketplace, we're seeing people who aren't really using a lot of housing assistance just because, at least from a purchase side of it, because everything goes too fast and it's, you don't get those type of sales. Obviously the housing authority helps people with Section 8 rentals and things like that, which is a good thing. But to compare, so what they're doing is the article is saying, hey, you've got the government over there, which is basically trying to stimulate affordable housing, and over here, by comparison, we're not doing that, so to speak, with like a physical group that's trying to create all these new programs or stuff. But the U.S. has Fannie Mae, Freddie Mac, Ginnie Mae, and FHA, in addition to the hundreds of programs at the city and state level, all designed to create affordable housing. And that's the key. Apparently, there's a lot of programs out there, but you just got to research them and find out. So my plan, once the whole COVID stuff is contained and they let us in, is to go to what's called the Tampa Housing Authority. to familiarize myself with what is available out there for purchases and for rentals as well too. So his point though is that not a single program has ever worked affordable housing, none ever will. The very act of getting people to buy homes creates more artificial demand and even artificial shortages. So the more promotion to buy homes actually hurts the overall people buying homes because, again, there's less of them out there and more people are looking for homes. There's more frustration, so people aren't getting homes. They're talking here, said there's another boom in the U.S. right now thanks to excessively cheap mortgage rates. So yes, this is fueling where we are today with respect to our mortgages, all right, and our housing prices. That did not make homes more affordable. Prices rose more than any interest rate benefit, and that's a really good point. So we know, and if anybody's done any research, okay, over the past, we'll call it 7, 8, 10 years of housing price gains and housing recovery, everyone touts, look at the housing recovery, look at the values, everything is great. Well, wage gain has not been anywhere near or close to housing price gain. So therefore, it is out of whack. So, it's great. It rose, housing prices rose, so we recovered, but how does that affect everyday buyers, the normal people who just need to get a mortgage and buy a property? Are they able to do that based on current rates, criteria, their income, living situations, the whole bit? So for me, it's not really, housing. Like is this our affordable housing? Well, we're creating our own affordable housing sort of ticket here with low interest rates. That's the answer, and we know that's going to catch up at some point in time. So who benefits from all this madness? Well, the answer is the banks and the builders. Banks make more loans, pass them off to Fannie and Freddie or Ginnie Mae, and the taxpayers are on the hook. So we are. Builders love the programs as they build more homes, which is great. In the UK scheme, the builders will either be compensated for a cost of repairs by the buyer or the government or some combination. There's no free lunch for the buyer or the taxpayer in any of these schemes here in the U.S., okay? And the Great Recession irony. In the wake of the Great Recession, home prices crashed, all right? Home prices crashed. Neither the Fed nor the banks or the U.S. government was happy with prices that were almost affordable in a decade. So in other words, we actually had affordable housing after the housing crash, but they all acted to force up the market so that new affordable home ideas surfaced, and they're actively promoted by the Fed, not just by the name. So that's the whole thing. So it's one of those deals where when we had the affordable homes, we didn't have the lending availability for people to buy them. Now we have the lending availability because a lot of things have changed, but we don't have the affordable inventory, which is the biggest catch-22. All right. One more thing to talk about here. We're getting close, guys, so just hang in there. COVID-19 mortgage bailouts declined slightly, but a new foreclosure crisis could be brewing. So, yeah. So basically they're saying here, as of this week, 3.7 borrowers still in the government and private sector mortgage forbearance programs. That's about 7% of all active mortgages, according to Black Knight. So again, Black Knight just keeps adjusting their forbearance numbers, or what they're calculating their numbers are, on a weekly basis based on who's leaving and who's coming to forbearance plans. I don't know where they're getting their data. They're probably getting a sample of their data from their lenders, all right? Whether it's 100% or whether it's extrapolated out from sample stuff, who knows, all right? So interesting. The number of seriously delinquent mortgages that are at least 90 days old more than doubled from May and June, hitting the highest level in over 5 years, according to CoreLogic. So this is where we go, okay, problematic here now. So maybe we're not putting in as many new forbearances, but we're going to start seeing some new foreclosure crises coming as this volume of delinquent mortgages starts to advance in the foreclosure time frame and go farther down the path, which means, as I said, the likelihood of coming out is diminished here. So when we look at this article a little bit deeper here, it says here 48. Where am I at here? Okay, what have we got? I'll find it in a second here, guys. More than 2 million forbearance plans are set to expire this month, and so far about 350,000 forbearance or borrowers have started making monthly payments again, which is good. On the other hand, about 3/4 of those still in the bailout plans, delaying their payments and sinking deeper into debt, are now in renewals. So as that chart showed here, okay, about 48,000 borrowers started their first forbearance plans this month, which is the lowest level since the bailouts began. So while the numbers are improving, the forecasts for foreclosure are deteriorating. So again, that whole boom and bust mentality. Some stuff is looking good in the marketplace, but others are getting worse, and that's probably going to be the segment that actually wins out to cause the issues. Number of seriously delinquent mortgages that were at least 90 days old doubled from May to June. The figure hit its highest level in the past 5 years. Barring further government support, experts predict serious delinquencies could double again by early 2022, which could seriously hurt home prices and home equity. So if we're into 2.25 million serious delinquencies and the expectations that would double, we are 4.5 million. Okay, now we're into previous housing crisis numbers in a much shorter period of time. So you don't think we're having a housing crash in the future? You don't think we're going to have a housing crisis? Think again. Okay, it's going to happen here. Forbearance has been an important tool helping many people, but again, we expect seriously delinquencies will continue to rise, particularly among lower income households, small business owners, and employees within sectors like tourism that have been hit hard by the pandemic and the shutdowns. All right, next slide here, guys. This is kind of important, all right? During the last foreclosure crisis a decade ago, close to 10 million Americans lost their homes, either through foreclosure or bank-approved short sales. The housing market is still recovering from that. Yeah, we still have people. First of all, we still have pockets of the country that have underwater homes. So the people are just paying their mortgage, but they can't sell without bringing money to the table, which is sad. So there's still that suffering right now, too. We still have backlogs of older vintage foreclosures that are hanging around, believe it or not. The housing market is still recovering from that. This time around, the numbers are likely to be much smaller as the overall market is much healthier. Well, that's great, but borrowers have significantly more equity in their homes, unlike a decade ago when home prices plummeted and millions were left underwater on their home, only more than the home was worth. We'll get to that point in a second here. So serious mortgage delinquency rate in June was triple what it was in March. It's going to go much higher. But not all these homeowners are destined to lose their homes in foreclosure. No, of course not. Some would go into the foreclosure proceedings. Many would rather sell and then lose all their home equity that they had gained through the appreciation of the past several years. So the core logic, dude. Now, I want to put this in perspective. This is the most important thing here, is that while some would go into foreclosure proceedings, many would sell rather than lose their home. Well, that's a subjective point there, because we don't know how many are going to go either way. But the point here, what they're not saying, is that, the minute you come out of forbearance and get tagged into foreclosure, all that non-payment stuff now is owed. It's like you just chop that out of your mortgage. So people are using the forbearance plan as almost like a secondary loan. Like they're taking almost like a loan out on their home, and then when the forbearance is over, that's got to be paid back. That's the situation. So what we forget to say here is that once your forbearance is over and you're now back into I got to do something about it, that money becomes due, and your $200,000 payoff is now $220, because now guess what? You're adding the 12 months worth of payments. Now you're adding interest and fees and attorney costs, all those things that go into the foreclosure process. All right. So there will be equity, but people will have less equity than they think. All right. So that's the whole point. Foreclosure filings are currently historically low. That's right, because there's no filings going on, hardly, and no processing going on, and no sales going on of foreclosure. So that's the reason why. This is no great phenomenon here. It will come back massively and hit us very hard. But they did jump up 11% from July to August. According to Adam Davis Solutions, its various state and federal moratoria on foreclosures lifted. So some states basically had moratoria lifted, and they were able to start processing some evictions and some of these foreclosure stuff right now. So several states, including Florida and New York, that have had foreclosure moratoria in place have recently loosened some of the restrictions, which may explain the unexpected bump in monthly numbers. And I have seen stuff get bumped up in the foreclosure calendar, so that is a true statement. Many courthouses across the country have been closed or had their cases dramatically reduced during the pandemic. It will be interesting to see if foreclosure starts continue to increase as these courthouses begin to reopen. Yes, they will. I'm looking at stuff now, and I see a certain increase as stuff kind of opens up state by state. And what I also notice is that a lot of the moratoria that's out there, sometimes when it gets renewed, like say you had your 3-month moratoria, moratorium and it got renewed for a month and it keeps getting renewed and renewed, well, guess what's going to happen now is language is changing. So some of the language they're either omitting or they're exempting or they're adding some language to the statute being renewed for 30 days or whatever it is. That's loosening some of the standards and opening things up, for the current situation. In the end, a lot of the stuff that's talked about with respect to the mortgages and the moratoriums, what they're moving to is you need to prove to me that COVID has affected your ability to not pay your rent or pay your mortgage, as opposed to just not deciding to and banking the money and playing the game. So that's where this is headed very shortly. All right, guys. So, hey, coming to a city near you. We talked about those, those top 10 locations. I mean, that's, the Houstons, the Tampas, Orlando, Riverside, Atlanta, although the big number of locations. I mean, that's just like the last housing crisis. More of these foreclosures are coming to a city near you. It doesn't matter where you live, it's going to increase. It's increasing in every state. I could give you 50 more slides of showing where all these increases are, but it just would take us, look, I'm already at 50 minutes here, okay, guys? Apologize for that, but I wanted to go through all this. I haven't had a long video in a while, and I think it's important to get to some of these numbers here. And here's the key. You know what? Put me on double speed, and that way it's only a 25-minute video, all right? So, I like to say this. This is your second chance at a once-in-a-lifetime opportunity. So, yes, we're going to have a housing crash and a housing crisis. Yes, there will be deals available. How much they're going to crash and how many there will be, that's the determining factor. I got lots of information on what I think is going to happen there. So you might want to reach out to me on that. And again, information, talk, deals, training, whatever you want to get involved with the real estate, reach me at my email right there. Happy to help everybody navigate through this very confusing and very interesting dual market housing boom and housing bust going on at the same time. All right, guys, Randy Patrick here. Appreciate the likes, the comments. Please share the video with friends and families. If you're not already a subscriber, please smash the subscriber button. Help my channel grow. I'd really appreciate it. Thank you. We'll look forward to speaking with you guys in a couple of days.